On this episode of Through the Pines, we'll cover risks that threaten wealth building, including inflation, stock market fluctuation, sequence of returns, distribution rate risk, interest rate risk, credit risk, concentration risk, and liability risk. So let's dive in. Welcome to a financial planning podcast with a down-to-earth vibe. Sasquatch listens while playing pickleball by himself. This is Through the Pines. Our advisors for this episode, we welcome back Rex.m.baxter and Brandyn Smith from planwithbaxter.com, the 2023 and 2024 and 2025 Forbes Best in State Wealth Management Teams for Utah, the Advisor Hub fastest growing advisors to watch under $1 billion, and the receivers of the Ameriprise Client Experience Award, which means they know what they are doing and they can be reached 24/7 at planwithbaxter.com. So congratulations, you've built up a good-sized nest egg of wealth. Now, what are the risks you need to look out for? Obviously, there's a variety of ways that you can lose money through scams, devices, etc. But today we'll discuss the major risks to a financial plan that we can look out for. So we'll start with risk on inflation. In more inflation than expected, Brandyn, what are we looking at here? How do we couch for this?
Yeah, it's easy to forget that inflation chews
eats our money.
It does because it's so. I mean, lately we've had a real bout of inflation. We all noticed that, right? You go to the grocery store, like, whoa! Since when did this price? And so we've seen it lately. But most times, what people don't understand is inflation can sit between that 1 or 2 and 3%. And that you don't really notice that so much every year, but over time it really adds up to the extent that, over retirement, things can double in cost. And if you haven't planned for that, that can be very, very risky. And so obviously that's something that, Rex and I do all the time. We're always, calculating for that. But frequently we see people who have gone out and they've bought some type of like annuity product, or they've, done some math in their head and said, all right, if I just do that, and they don't understand that you need to plan for that compounding interest of inflation over time.
Rex, what's the average annual percentage of a raise people get from their employers?
Oh, it's low. The average annual is probably close to 2%. 1.5%.
Yeah.
Something
so
like
every
that.
year when you get a raise, you're keeping up with inflation.
Almost.
Yeah. If you are, right?
Yeah. It's close, right? I think the long-term inflation rate's about 2.1 or something like that is the long-term inflation average. And so if you're increasing your wages by about 2, the issue is that, especially here recently, right, we just went through a bout of inflation of 8 to 9% during 2022. And wages absolutely were not keeping up with inflation and still aren't quite up to that yet. And so that inflation went up 8 to 9%, and then it slowed down to 5 or 6, and now we're back down closer to just under 3%. And wages have continued to kind of increase by a little bit higher than normal, to where we've been increasing by about 3% on wages, 3.5%. And yet we're still not back up to the parity that we were at prior to that inflationary bout in 2022. And so the best estimates are that by about 2027, wages should catch close, back up close to that rate that we were at prior to the inflationary
bout. That's a long time.
Bout. Yeah.
Yeah. I think one of the things when you're planning for retirement, understanding inflation is important, because you need inflation. What does inflation hurt? It hurts people who own cash, right? Because ultimately that's what's getting inflated away. The value of your currency is going away. So if you own cash, that, inflation is bad. If you own a promissory note of someone to pay you cash in the future, that's also highly susceptible to inflation risk. Now, what is that? It's a CD, right? It's a bond. It's a fixed annuity payment, right? It's these things that we sign up for and feel really, really good about, because usually it's a guaranteed payment of cash in the future. And we say, this is great. Mm-hmm. And in our minds, that can sound really, really good today, when we say, wow, I'm going to get X amount of dollars for the rest of my life, and that sounds like amazing, and I can live off that for the rest of my life, but you don't understand that 10, 20, 30 years from now, that's not going to cut it. That's not going to be nearly as much as it is today.
How have you changed because of 2022, or have you changed when you're doing retirement plans? Because did you before then think, oh my gosh, there's going to be a year where there's 9% inflation?
Absolutely. We figured that, everything kind of goes in cycles.
Yeah.
And inflation is not an exception to that. And so we went through the late 70s and mid 80s with extremely high inflation during that time period, to where we had 12% inflation, 14% inflation during some of those years, and then inflation kind of slowed down, and we got into the 90s and 2000 and 2010s and things like that with really low inflation, to where inflation was around 1.5% to 2% and traditionally really, really low, but as working in the financial planning industry, it's our role, it is to plan and to model out what happens if we have hyperinflation, because 2022 and years like that will experience more of those. We're not done with inflation. All of a sudden, when inflation comes back down to 2% or 2.5% or wherever we end up at, which is kind of the Fed mandate, is to try and keep inflation down around that 2 to 2.5%. That's not always going to be the case. Mm-hmm. And so it will have other spikes, and that's typically caused by a lot of money coming into the money supply, whether it's government programs, government bailouts, and the inflation doesn't happen the year that money supply comes into the economy, but it typically trails by a period of time, and is by a year or 2 or 3 to where we start to see and feel that.
What number do you use for retirement? You average it out to a certain number?
Yeah, most of the time we use 2.5% to 3% is typically what we use. If it's a more aggressive client and they're comfortable taking a little bit more risk and they're comfortable, kind of keeping it Skinner, we'll be on the 2.5% range for long-term inflation. If it's a really conservative client and they really get nervous about different things, sometimes we'll inflate that up to 3%.
Yeah, because we're talking about avoiding risk and keeping your wealth. So maybe you plan high on that in case there's rough years like 2022.
Certainly look at high, right? I mean, there's certainly additional concerns about being too conservative in your estimates. Because if all of a sudden we say, oh, well, heck, let's look at 5% long-term average inflation rate, right? Then all of a sudden it's the impacts of that are it's going to kind of force you to take additional market risk or return risk because you have to outpace that inflation more than you might normally be comfortable doing. Or it may cause you to adjust your spending and lifestyle to where you're not living quite as much. And maybe I should leave this for Brandon. He's the live for today guy. So, but you might cut back your spending. Brandon. You're not alone. You might cut back your spending a little bit more than you have to.
Yeah.
Because you're being so conservative, and then you may pass away with large sums, and that's where I come back to Brandon, to where that might not be the goal.
Right. So. Yep. Well, and to be clear, in 2019, none of us were like, "Oh yeah, here comes another bout of inflation."
What?
Right?
Yeah,
nobody. Yeah, and you couldn't have known, right? Like that would have just been a wild guess. And so we're always thinking of it and conscious about it. And we even talk to clients about it. Like, hey, this is just in case we see higher inflation, lower market returns, premature death, right? We're always kind of running those scenarios because we don't know when it will happen, but we figure it will happen again. And that's where you've got to be careful with how much are we locking into future payments that are going to be received in cash, because that sounds great today, but in 10 years, if we go through another bout of inflation, that might immediately devalue that entire investment. So someone sitting in this giant portfolio of CDs and bonds might feel really, really safe, but then not realize that there's this risk of inflation that, unbeknownst to all of us, 2-3 years from now, we could see a huge chunk of that portfolio just inflated away. Right? You're still getting your same dollar amount, but the value just isn't there.
Rex, will you take this opportunity to just explain why this is a good reason to use a financial planner? In other words, there's so many apps, and you even have your own software that runs scenarios, but the human element of just being alive and living through these things and just knowing what to look for, I don't know if all of the software and the apps can account for all of the things. Like, who thinks of all the things?
Yeah, I'm not sure anybody thinks of all the things, right? But I think the power of experience is marrying the experience and the history of what can happen and what is happening about what might happen. And you're marrying that with a person's psychology and how they're going to emotionally react during those different stages. And a computer just can't do that yet, right? It's not going to be able to walk you through that. And so for those that are out there and trying to use, different AI resources and things like that, it certainly is a wealth of information, right? And we utilize AI in a lot of different ways as well. But the thing it can't do is it can't tell you what the right questions are to ask it.
Oh, yeah.
Right? And so the input that you're going to get back is only as good as the prompts that you're putting in.
Sure.
And on top of that, there's still a lot of poor information that comes out of AI. I had every now and then I'll just go in and ask, Copilot or different AI resources, different questions to see kind of what the answers are.
Yeah.
And I had asked it the other day, just how much can, an 18-year-old contribute into a Roth IRA, and it came back with the wrong answer. Mm-hmm. And that seems like a really simple question. Yeah. Right? It's very finite. That
should be printed somewhere where it should pick it up.
It's printed in a lot of resources, right? Yeah. It's in the IRS guidelines. It's in a lot of resources, and yet it still had the wrong number there. And so, you still have to, you want to trust but verify, if you will. Yep. And so you want to double check and see if you're even asking it the right questions. But we feel like we have a pretty good handle on making sure that we're asking the right questions of our clients, as well as making sure that we're coming back with, the best answer and fit for them and their individual and unique situation. That may not be the right answer for their family members. It may not be the right answer for their work friends or social friends, things like that.
Yeah. Very good. Okay, let's move on to the next risk, which is stock market fluctuation. What? The market fluctuates?
What?
That's inconceivable.
It doesn't go straight up?
Over time, there's only one direction that it goes.
Probably the best benefit of this risk is everybody at least somewhat understands it going into it, right? Like, a lot of people don't understand inflation risk or sequence of return risk or all these other risks we're talking about. Stock market risk, everybody's got a good idea that it exists, right? They may not understand,
and it might even prevent them from participating at all in the stock market because they don't understand the risk of it.
A lot of times that's the case.
And usually it's a misunderstanding of what stock market risk is. And that's something I love to make sure I talk to clients about and ask them, well, what is stock market risk? When we invest in a diversified portfolio, meaning a lot of different stocks, and we put those together and we invest, is the risk that is going to go away? Like the money just disappears and goes to zero? Yeah. It's possible.
Anything. The market monster eats my money.
Anything is possible, right? Yeah. But what does that look like? That looks like all of the companies that you hold going out of business, right? No longer becoming profitable, right? Walmart closing their doors, Amazon stopping packages, right? Apple stops iPhones, right? Like could that world exist? Of course it could, but it's a very unlikely scenario, right? That's what it would take for the stock market to be worth zero, is these companies unable to be profitable, because the profits of these companies are what drives the value of it. Now, that's not to say we couldn't see, changes and fluctuations, because that absolutely happens, right? Because companies have business models, right? And those business models are to repeat the same thing over and over. And if they're doing it right, they end up with a big sum of money at the end, right? And what do they do with that? They either pay it out as dividends, or they use that money to build future infrastructure or build future projects that make your stock worth more money. The problem with the stock market is it's very speculative, meaning that it's based not necessarily on yesterday's numbers, but where people think the stock is going to be in the future. And that's why you get stocks that maybe haven't even had a profit yet, but that are worth billions and billions of dollars because people think that in the future it's going to generate more wealth.
Yeah, stock prices, I agree with everything you said. Stock prices over time will follow earnings over time. And so I think that there are some areas of stock market risk that you can mitigate and some areas that you can't. And so an area of that would be, if you can reduce company-specific risk by owning multiple companies, right? You can reduce sector risk by owning, instead of owning all technology, you could own technology and healthcare and utilities and different areas of the market to reduce that specific stock market risk. Those things you can mitigate. But there are certain types of risks in the stock market that you can't. And so sometimes there's weakness in the overall economy. And so you can reduce country risk, right, and not have all of your money in French companies, and you have some German companies, and you have some U.S. companies and Canadian companies and so forth, to reduce kind of country-specific risk. But if the overall U.S. economy or that international economy slows down, then that is going to impact corporate earnings, which will impact those stock prices, which is going to bring those stock prices down for a period of time. Mm-hmm. And that kind of risk is systemic risk that you just can't eliminate. And so and that's why you're getting compensated a higher return over time is for that risk that you're taking. And so there's a direct correlation over time between risk and return. And so, we see all these fraud cases from time to time about, so-and-so says I'm going to be able to get 8% in the next 60 days. And when you annualize that out, that's a 48% annualized return. And the stock market typically gives you 10 to 12 over time. And so if someone's saying that you can get a 48% annual return, that should set off all kinds of alarm bells.
Well,
right?
They obviously know something I don't know.
Well, they do. They probably know how to scam you out of your money.
That's what it is.
That's probably what they know that you don't know.
And then, so when you're planning, do you use numbers even lower than 10 to 12? Like 8?
A lot of times we do, because again, we're looking out into, for the next 3 years, 5 years, 10 years, 30 years, 40 years. Mm-hmm. And so we want to use capital market assumptions as to what that next period of time might look like. And we want to be conservative in those estimates. And so for aggressive investors, we may use a 7% rate of return, long-term rate of return. We may use, for a conservative investor, we may use, 4% or 5% or something like that. And so we certainly are going to be a little bit more conservative in our numbers when we're projecting them out 10, 20, 30 years, because we've gone through decades where we've had a zero return or a negative return. I think the worst decade in history had a negative 3% rate of return, roughly, which was during the Great Depression. But it happened, and it can happen again, right? We had a decade of no return, or a negative 1% roughly, from 2000 to 2010. And so those things can happen. And so you need to be prepared for that just because a long-term rate of return might be 10 to 12, that doesn't mean that the next decade couldn't be zero. Yep. It could be zero. And so you need to prepare for that.
Yeah. I think the number one thing as we talk about market risk is acknowledging that we might, you look at 2008, you look at 2000, those crash and the market can cut in half in value really, really quickly. And it can take, although it usually only takes a few months to, maybe 18 months to recover, it's possible. And those really deep ones, it's taken 5 years, right? And so that when we talk about risk of the stock market, that is what we're worried about, is that we could see dramatic change in value and that it might take us 5 years to come back from. Now, if you're in your 20s, 30s, 40s, does that matter? No, right? Like, as long as we keep our head on straight, as long as we're diversified and that can bounce back and come back, then we're not worried about it. Why do we use the stock market? Because it's had such great historical rates of return, and from everything we can see, should continue to have good rates of return. And so that's why so many people like to participate in the market. You just have to understand it can fluctuate and it can take several years to come back. When you're younger, that's fine. We can accept that risk, and we like to accept that risk in exchange for the higher rate of return. as you get closer to retirement, we need to hedge that risk and take some of that, not all of it, but some of that risk off the table.
Rex, why are so many people psychologically opposed to confronting these risks?
Well, I think they don't understand it typically. And so I think that sometimes they've seen their parents lose money, or they've seen their friends or neighbors. A lot of people talk about the best and the worst and not the average. And so when you're talking to a friend, typically they'll share with you the worst experience they've had in the stock market.
Or best.
Or the best.
Said, like, right. I made all this money off Bitcoin and so-and-so is a millionaire now. And then it's like, okay, well, it's feast or famine.
Well, and then they try it.
And they're not as successful.
And they can't replicate it, right? And so then all of a sudden they lose a ton of money. But I think typically it comes from lack of understanding what the risk is and understanding what role that risk plays in their overall picture. And yet I think that they are scared. And I think some of that comes down to generational. And so, you deal with the current millennials who I think are great savers and poor investors so far. And I think that that's because they experienced the Great Recession of 2008, the financial depression that we had there, to 2012. And I think that scarred their investment experience. And I think it's getting compounded on the upside of cryptocurrency and how strong cryptocurrency has been, with them thinking that is virtually zero risk. And that is certainly not the case. But their experience is, if I'm just patient, crypto, all it does is go up, right? We might have some dips here and there, but crypto is the wave of the future, and they get in this mindset where we've seen a lot of things like that over time, whether it be the car industry when they came out, in the turn of the 1900s, or the airline industry as that came in place, to where you have hundreds of different car companies or hundreds of different airline companies. And when crypto started, we had a lot of different cryptos, right? And that's starting to get narrowed down to some extent. But are you in the winning one? I don't know. And is it going to go up forever? Probably not.
All right, next on risks and avoiding risks when building wealth, sequence of returns. Explain this to me, Brandon. Yeah,
sequence of return rate risk is if you want something kind of fun to look up, right? You can look into essentially what it is you can run two scenarios, two identical people. They retire at the same age with the same amount of money, spend the same amount of money in retirement, and the only difference is the year that they retire, right? And that year might be, 5-10 years apart. And one of them, with all the same assumptions, goes on and has, like, their portfolio grows into multiple millions, and they've got more money than they ever need. And one runs out of money after 15 years. And
that doesn't sound possible. That's crazy.
Oh yeah, that's what I said. It's kind of fun to look up, right?
Yeah.
Like you look at it, you're like, how is this even possible? And you go back and look at the numbers, and then it's real, right? And essentially the assumption that is wrong, and how we avoid that with our clients is how they built the portfolio, right? So it's just an all aggressive portfolio, all in the stock market, and if they just simply leave it invested and just keep pulling at those same rates, it's just the timing of when recessions hit. It's the timing of booms and busts of the economy. And so when we do financial plans for people, we have to make sure that we've got enough set aside so that we can avoid this potential sequence of returns risk and be able to draw from sources that aren't tied up directly in the stock market during downtimes.
Okay. Rex, anything on that?
Yeah, an easy example of that, if you can follow numbers over a podcast.
Yeah. Never easy, by the way.
Never easy. Yeah. We're going to see how good I am at this or not, and be kind in your comments if you decide to respond. Okay, but let's say you have two portfolios.
Okay.
One portfolio over 5 years hits 10% a year. Year one, 10%, year two, 10%, year three, 10%, right? And you start with $100,000. So you go to, and let's just say it's simple interest, right? 100 to 110 to 120 to 130 and so forth. So you end up with 150 grand at the end of 5 years. The other portfolio is a little more volatile, right? And so your 100,000, you lose 50% the first year for your sequence.
Oh, that's a lot. Yeah.
So you're down to 50 grand.
Yeah.
The next 3 years, you get 0% on it. So it's 0, 0, 0. And then in the fifth year, you double your money, right? You get 100% return. So the average of that is still 50%, right? 10% a year, right? However, you lost 50% of 100,000, so you're down to $50,000, 0, 0, 0, and then you double your money and you make 100% on 50,000, so you're at 100,000. Both portfolios average 10%.
Yeah.
Right? One's worth 150 grand, one's worth 100 grand.
That's what's blowing my mind right now. That's the coolest thing. Yeah.
Right?
Yeah.
Both average 10. So that is the sequence of returns. That's the risk of sequence of returns in a nutshell.
Yeah. Yeah, because that's why.
Did I succeed? Did I do
was
that
really good.
over a
You nailed
podcast?
it. Good job.
That was pretty
All right.
good because and you can't, you can't plan for that. Like you don't know that the year you retire.
But you can plan for that.
Okay, tell me how.
Because you diversify that out so that when you have to pull money out, you pull from somewhere else. But because of that volatility, what you're not seeing is year 6, 7, and 8. And year 6, 7, and 8, maybe you're up 50% and 40% and 30%, those other up years that then surpass the steady 10% return. And so that volatility over time in the market will play in your favor. Because we have more up years than down years, and because we're averaging that 10 to 12% over time, and those up years, that typically comes in the form of 1 year we're up 20% or 25%, and then 1 year we're down 10, and so forth is kind of how that tends to wash out. And so over time, that will work in your favor, that volatility, especially if you're dollar cost averaging and you're adding, because if all of a sudden you're adding money at when it's down 50%, you're buying more and more shares or units of that mutual fund or whatever the case may be, and then all of a sudden it doubles in that year 5, you just leapfrogged the other portfolio because you're adding and buying so many shares while it's depressed.
Yeah, because if you started at 0 in those two same scenarios and started at 0 and added each year, that second scenario is by far the better scenario.
Right.
I mean, that's what you'd want if you could choose, right? But if you've got money already and you're in retirement and you're trying to, it's like Greg said, it's a far inferior portfolio. And so, and that's also why it's important that when you're reviewing your numbers with your advisor, that you're actually looking at what's my net effective rate of return? Like what's really happening with my money? Let's see a chart. Let's see how the money's actually grown. Where did we start? How much have we grown the money? Where are we at today? And so that you're actually making sure that there's no weird smoke and mirrors with the rates of return. Because occasionally we see that with other firms
because a planner could say, yeah, but you're averaging 13%. What are you mad about? Like, well, I don't have any money left. That's what I'm mad about.
Right. Well, it's because I needed my money when it was down 50%.
Yeah.
And so I had to pull a bunch of money out, and therefore I didn't have the money in the market to recover for that 13% long-term average. And the other issue is a lot of times we see inflated estimates of those rates of return on projections. And so it's funny, somebody will come to us the first time and we'll run through some planning numbers and some projections and things like that with them. And then they'll go to a competitor, right? And they'll run through projections and they're like, oh, but this one gets me a lot more money. And it's like, well, wait a minute, let's look and see if we're comparing apples and apples. And next thing we know, they're taking significantly more risks on the other portfolio, but not necessarily showing that it's taking more risk to try and justify that higher return that they're getting, which if you dig into that particular client, they may be highly uncomfortable with that risk and make a really poor life decision during those market downturns at the worst time that they could make a bad decision.
Yeah. That can't be easy. You're the financial planners, and so you're the ones that have to go in and have those conversations, but that's got to be hard to be up against sometimes.
It sometimes, right? I mean, it depends on the clients and who they are and the personality. As long as you come in with an open mind and you're willing to listen and look and you're there with, wanting to be educated and wanting to learn and make sure that you understand where people are coming from, then typically it's a really easy conversation, right? Because you're wanting to learn, wanting to understand and things like that. But it's really easy to get your head emotionally already down the path of bigger returns. And sometimes you get so far down that path that you can't unwind it until it's too late. And typically what'll happen is they'll have a bad experience and they come back to us and have another conversation with us and they're like, no, you're right. I was highly uncomfortable. That is not what I want. And I couldn't tolerate that, and so I ended up selling out. Unfortunately, sometimes that scars the clients to such a degree that then that compounds the problem to where then they lock in really low risk and low rates of return for the next 10 or 20 years to where they're just doing CDs or CD rates or things like that because it scars them. They're so nervous about the market risk to where they don't have any exposure there, and then that handcuffs their retirement.
Okay, Brandon, the next in risk here to wealth, and actually I like Rex's take on it too, the distribution rate risk, because I think, Rex, you said something like you wanted to make make your nest egg so big that your distribution can be less, right? Is that?
I think Brandyn said that in one of our previous podcasts.
Yeah. Okay. Yeah. Walk me through, Brandyn.
So there in finance, there's the thing called the rule of 4%. And you may have heard of it. If you want another interesting read, you look it up. Does the rule of 4% still apply? And you get people arguing both sides, like, no, 4%. But what the rule of 4% is...
I've seen those articles.
They're funny. Yeah. The rule of 4% essentially just says, hey, everyone wants to know how much can I pull out of my portfolio and have a good chance of never running out of money.
Which, oddly enough, for years, I was thinking 10%. I'm like, the market's going to average 10 to 12, right?
Right. You would think that. You would think, right?
That's what I'm thinking.
Yeah. And so obviously it depends on your portfolio allocation, meaning are we very aggressive or are we a little bit more conservative? Knowing that we're going to go through recessions during an average retirement, we need to have money set aside that's not in the market. Right? Which if we have money set aside in bonds, if we have money a little bit in like cash alternatives like CDs, things like that, we're inevitably going to get less than the average market rate of return. Right? So we give up some of those high rates of return that we enjoyed earlier in the accumulation phase for the safety and security of knowing the portfolio is not going to be whipsawing around as much, and knowing that we have places to draw from if we go into recession. But if we're in a moderate portfolio, we can pull 4%, which is you take your portfolio. If you got a $1.5 million, right? 4% of that is $60,000. We can pull $60,000 out each year, increase that each year for inflation, right? So it's $60,000 now, $61,000 the next year, right? And you increase that each year and have a very high probability of never running out of money. And it depends on
I noticed you said high probability and not a zero chance.
Around 90% probability, okay. Right? That we have.
That's pretty high.
Yeah, enough or more than enough. And that's more likely the scenario, right? Is that we've got more than we need in most of the probabilities if we can stick to that 4% distribution rate.
Okay.
Now, as we increase that, if we go from 4% to a 5%, then we're between a 60 and 70%
yeah, you're pushing your luck a little bit.
Yeah. And can we do that? Well, some clients say, I'm all right with that, right? Like I need this extra income. The difference between, 5%, that adds quite a bit of income to a portfolio, right? On $1 million, right? That goes from $40,000 a year to $50,000 a year, right? So that adds that extra $10,000. And so, people are saying, hey, I'm willing to take that risk, understanding that, in a fairly possible scenario, I may need to reduce my spending in the future. And you kind of have to understand that risk before you move forward on it.
Okay. Rex?
Yeah, I agree with all of that. It's difficult to reduce your spending. If you're taking a 5% distribution rate or a 6% distribution rate, and all of a sudden you have to reduce your spending, it's not as if you're going down to 5.5 or 4.5. Lots of times you're having to take it down to 3.
No, and that could be
right? And that's
$1,000 a month or something,
or 2.
Yeah,
right. That's significant in your life, especially because now you've adjusted your lifestyle to that. And if you've committed to payments, like on a car or different things like that, and you have commitments that you're having to pay, and you're having to reduce the lifestyle, that gets really difficult. So the other piece that plays into this is age. Right? If you're 98 years old,
right,
you could probably pull out more than 4% if you want. Right? And so you could probably pull out 10 or 12. Right? And so age plays a factor into this as well, as far as how long do we need the money to last. The 4% rule is designed to last in perpetuity, is what the 4% rule is. And so essentially the theory is that you're making 6.5% on your money roughly 2% of that is going to inflation. You're pulling out 4%. And so that's how it's able to keep up with inflation and never touch the principal. Mm-hmm. And so there's the opposing argument is, well, I don't want to die with just that inflated dollar amount. I want, right, there's I can't remember if it's Susie Orman. I want to die broke, right? I want to die at zero. And so I want to spend more than the 4% because I don't mind seeing my capital decrease over my lifetime as long as I have enough of a buffer to cover the needs that I need to when I need it most, which might be long-term care or health care in my later years. But that's the risk you're taking, is because there is a failure rate that if all of a sudden you're taking out that 5% or that 6% or 10%, like you mentioned, right? Yep. Then there's a much higher risk that all of a sudden you not only die broke, but you live broke. Yeah. Right. Well, before you die, and that's uncomfortable.
And then there's the option to build the nest egg up and only to a percentage or to an amount that you can take out a smaller percentage, 2 or 3, and watch the nest egg grow potentially, if that's what your goal is.
Yeah.
Yeah, you'd watch it compound almost exponentially, over time, over a long enough period of time.
And usually that's what happens at the 4%. Usually, right? Because that 90% probability, that's assuming a 30-year retirement. Yeah. And so if you think, man, 30 or 90% of those scenarios likely end up with enough or more than enough money, you can see that a few of those scenarios are going to end up with dramatically more, just kind of going back to that sequence of return. When did you retire within those economic cycles? And it might be easy to take from this, like, oh, maybe I need to plan my retirement around economic cycles. I think that's a mistake.
You can't do that.
You can't. Yeah. Right. And the temptation, I get it, but at the end of the day, you just can't predict it well enough. And plus you don't want to give up. You don't want to be 65 and be like, hey, I think I'm going to, work another 5 years because why not? Well, those 5 years are very important, to make memories and do those things. So.
Okay, so the next risk that we have to consider on our wealth is interest rate risk, Brandon.
Yeah, interest rate risk, and this is more specific to bonds, but also plays into CDs, and that is the risk that interest rates change on you. And how likely is that? Well, it's pretty likely, right? The interest rates have changed all through time. And so specifically with a bond portfolio, the risk is, and let me just describe really quick how a bond works, because I know a lot of times people don't follow like bonds and things like that. And so a bond, a corporation or a government entity might say, hey, we need to raise some money. And so they come to, offer a bond offering, say, hey, Brandon, if you give me $1,000, I'll take that $1,000. I'll pay you a set interest rate on it. Call it 5%. I'll pay you 5% every year. So you get $50 every year. At the end of a set period of time, call it 10 years, I'm going to give you your $1,000 back. That's a bond. Right. The nice thing about a lot of bonds is they're traded in the public market, which we use that. And so what that means is it gives you liquidity. So you can buy your bond, you're getting your coupon, right? You're getting your interest, your 5%. But what happens if all of a sudden interest rates go down? Right? They go from now all the bonds are paying, they were paying 5%, now they're all paying 3%. Who wants your bond that's paying 5% when everyone else is paying 3%?
I do. Everybody. I want it.
Yeah. You have a whole line of people. And so what happens to the value of your bond? It jumps, right? Yeah. You can sell your bond not for $1,000, but maybe for $1,100. And that can be really, really beneficial. Well, the same is true on the inverse. What happens if you got your bond, you're earning your 5%, all of a sudden interest rates go up to 7%. Who wants your 5% bond? Nobody, right? And so you have to discount your bond and sell it for $800 or $900 if you want to sell it, because you have to kind of match that current yield is effectively what's happening. So it's a very fair system, but there's risk there, right? You could have this bond portfolio and say, hey, wow, as long as this corporation stays in business, or as long as the government stays in business, which they're good at staying in business, I'm going to get my set interest rate. And then all of a sudden you look at your portfolio and it's gone down in value because interest rates went up. And now nobody wants your bonds as much as you thought they were worth, right? That $1,000. And you can see some fluctuation in interest rate risk. And so that's the first major one in the bond. realm, but then also in CDs, right? People, and it's so funny, right? CDs were sitting paying almost nothing for the longest time. Then all of a sudden we see a little bit of interest rate movement and people are like, wow, I'm generating money. And next thing you know, you hear people like planning on living on their CDs in retirement. Like they're going to continue to get 4 to 5% on the CDs. No, right? Like you've got that interest rate risk where all of a sudden you've got your CD, it's locked in for a year, maybe 2 years, but then interest rates drop back down to 2-3%. Now, when you renew that CD, you're going to get that lower interest rate risk. And what did you get for it? Unlike a bond portfolio, you didn't get that boost, when interest rates dropped. You don't get to continue that payment for longer terms like those bonds. Your CD just renews and usually at that lower rate.
There's on CDs get tricky because you have 2 different types of CDs. You have a secondary market that is in the CD market also, to where people will buy and sell used CDs, if you will. And then there's a private market.
That means something totally different to us from the 90s, by the way.
I know it does. We're not talking about Greywood. CDs here.
Right. So,
yeah.
Yeah, okay.
So, but then there's private CDs where a bank doesn't offer them on a secondary market. And so you don't see the fluctuation from interest rates. They don't price them. They don't mark them to market or price them daily on there, and so it hides the interest rate fluctuation from you and gives you a false sense of stability in the pricing of those CDs. And yet when they come due, if all of a sudden interest rates went from 5% to 3%, again, you'll get your $1,000 back, but then when you go to roll it, now instead of getting $50 a year, you're getting $30. And that's definitely a risk that's out there. The other thing that plays into the interest rate risk on bonds is whether you own the security directly and individually, or whether you own it in a pooled investment. If you own it in a mutual fund, for instance, there's a lot of buying and selling that's happening in the mutual fund. Brandon might need his money tomorrow, and I might be investing for 10 years, and so he's going to sell out tomorrow, and so all of a sudden it can create some inefficiencies in the market, because he's got to dump all of his bonds all at once, creating a bunch of selling at an inopportune time, and then that pooled investment, that mutual fund, has to go and use the proceeds from that sell and go and get that reinvested at different periods as people make new deposits into the fund at this lower interest rate that might be there, or a higher interest rate. And so it creates additional volatility if you're not holding an individual security to maturity. And that's where that interest rate risk comes into play that we need to be careful of.
Yeah. Okay, this is good stuff. I think let's take a quick break from risks and do some more numbers, Brandon.
You got it. So this was done. The source was National Association of Realtors, and First Trust put this together. But it was kind of a cool chart. It shows, and I wish I could show it, but I will describe it hopefully as well as Rex did his numbers. But the average age of home ownership, of first-time home ownership. And it's kind of interesting. In the 80s, it was actually in the late 20s. So when you were in your late 20s, that was kind of the average time to buy a home. We saw that it jump up in the 90s and in the 2000s to where it was between age 30 and 35 was kind of the average time to own a home. That dropped, no surprise, in 2008 when we had that it got really bad. The economy got bad, but the home supply was, excessive, right? You just had foreclosed on homes all the time.
Prices came down significantly during that time with lower interest rates to boot.
Yeah, yep. And so you saw that come down actually right on about 30 years old was the average first-time home purchase. But then unfortunately after that, we saw steady increase in that age. And so, in 2011, it was up around, 31, 32, and then just continued to grow until today. It's up above in the kind of late 30s.
I thought you were going to say 60s.
38, which is the highest on record.
38. Yeah, that's the oldest I can think of.
Yeah.
For sure.
Yeah.
Interesting.
Yeah, and you can always email that because I can put it up when you during the shows. Fascinating and depressing if you're in your early 20s and you want to buy a house, because that typically means it's just harder to save the money and make the purchase, I guess. So that's why it takes longer years to get the money to buy the house.
Yeah, it takes longer to save up that money to afford it, or it takes a lot of creativity on how to get that first home purchase done. Right.
And these are just numbers, right? This doesn't say why this is happening. Some of it can be cultural, right? Where maybe a demographic says, home ownership, this sounds great, maybe later. Right now I'm enjoying traveling, or I'm enjoying, whatever. I enjoy not having to worry about a yard or something like that.
Yeah.
So it's, it is what it is, but it does, obviously it is getting harder.
They do say that, the current generations that are in that market, so the millennial generation is not as interested in home ownership as previous generations.
Well, I was going to ask you that because I follow this young influencer gal who's she's in sales, and she talks a lot of sales stuff. And then she did this short reel, whatever, where she talks about her and her boyfriend lease a house, and she owns houses, but they're all rentals. But the one that she lives in, she leases from someone, this is in California, that they convinced to lease to them because it's going to take a while for them to sell this house. But it's at like a fraction of the cost of the monthly lease because it's a house that is for sale. So they have to give up, like, if someone needs to see the house, they got to get out of the house. Yeah. But they're leasing, and she and I have all my work stuff there, and so I write it off as an expense, and so she's not looking to buy a home to live in. But I didn't know if I'm like, okay, that's now we're doing some crazy stuff. But I didn't know if you're seeing leasing as just more of a way to live for the generation of those who are in the 20s and 30s right now versus buying and, like you said, mowing lawns and fixing up the house and doing
I think that's where the creativity comes in, right? Whether it's a lease or rent to own or a for sale by owner with owner financing, right? Anytime you get into a situation where home prices are higher and interest rates are higher, which I would argue interest rates aren't higher. I would argue that interest rates are the historical average right now.
6.7.
Yeah, but it feels. So, is that a thing? I heard that's a thing.
Don't worry, Rex. Don't worry.
I've even looked it up. It's pretty nonsensical.
That's the whole point of it, too.
That's a separate podcast.
It is. God, I hope not.
Yeah. So historically, right, as 6% interest rate, 6.5% interest rate is kind of the long-term rate.
Yeah.
And yet, here we are at 6% interest rates, and people feel like it's outrageous, but it's because we're coming from a 2.5% interest rate on mortgages or a 3% interest rate on mortgages.
It's outrageous when it's paired with the price of the house, because affordability of homes is at an all-time low.
Affordability of a house in comparison to gross income.
Correct.
To take-home income.
Which is the best
Which I would agree, because income has not kept up with inflation to this point. However, projections are that income will catch up to inflation, and so that should come back into alignment over the next few years, but it may take a couple of years. But this is a painful period.
Yeah. And we get that. People say, well, I remember when interest rates were higher, and that's true. Right. And it felt bad when interest rates went up back then. But at the end of the day, when you look at, like you said, the average median income relative to the average median payment on a house, when you take, the cost of the house with the interest rate factored into it, I mean, this is one of the hardest times to buy a house. Now, the other argument to that is houses have gotten bigger, more complex, more technology. I mean, the houses today are a lot nicer than they were 40, 50 years ago. But it's kind of an interesting thing to look at.
I worked in the industry as a loan officer in 2005 and up to 2010. And yeah, when rates dropped to 6, people were losing that. We were refinance. You can get someone below 6. They were rushing
right.
to refinance their house.
Yeah,
because they were stoked. And then
their $80,000 house, they were rushing to refinance.
100%.
At 6%. How did you guys afford that? Just kidding.
And then like, I'm on a 3.25 loan, And people are like, well, you don't want to. I'm like, dude, I'm on a 3 1/4. Like, you can't find that. So I don't know if that'll ever happen. It'll be a while. So
yeah, I'm not sure we'll see those kinds of rates during our lifetime. We might, right? Things go in cycle, and so we may get in a situation where the economy is really struggling and they bring rates down that low again. But I don't see it happening anytime soon. But it could.
Yeah, that's wild. All right, back to risks on wealth, credit risk, Brandon.
Yeah, I don't think we need to spend a ton of time on this, but I think credit risk is when you own a portfolio of bonds. That sounds great. You get your $1,000, you get your payment on your $1,000 every year, semi-annually. But what might stop that? The business going bankrupt. Right? Like that's what stops it. Now that business can completely flounder. That business can kind of just barely keep its doors open. You're a creditor of that company, right? And so they have to legally are required to pay you if there is any money there whatsoever. The stock could completely tank and be worth next to zero, trading as a penny stock, but you still get your bond interest rate back, or your bond interest, as long as they're able to do that. But sometimes businesses go bankrupt, right? And so you can even and of course being traded on a secondary market, people anticipate that. And so you might have a bond that the company stayed in business from start to end, but in the middle had kind of like a really rough patch, and people said, "Oh, I don't know if they're going to make it. I don't know if I'm going to get this $1,000 back. Who wants to buy this bond that may or may not be here in 5 years?" It's harder to sell that. Now, if you hold that to maturity and they end up being there, you still get your $1,000 back and the interest all along the way. But there is such a thing as credit risk. And so when you build a bond portfolio, it's not just about the yield that you're getting, but understanding what kind of risk are we taking within that portfolio.
Okay.
Yeah, I agree. Again, risk and return directly correlated.
Yes. Yep.
Right.
Yep.
And I love marketing. Because instead of calling a bond a high risk bond, they called a high yield bond.
Yeah, that's true.
Or a high income bond, or a strategic income bond,
right.
Or a
that
right.
Sounds so good.
That sounds so much better than high risk.
Yeah.
Junk bond.
Right. In the industry, we call them junk bonds, but I've never looked up like a portfolio ticker that was like the junk bond portfolio.
There is an ETF out there that's like
they
JNK,
call it? Oh,
right?
Really?
For
that's
like
funny.
junk.
That's funny.
You've got to be careful because credit risk is real. Just like we as individuals have credit scores, companies have credit scores,
right.
And countries have credit scores. Municipalities, right, and tax-free bonds have credit scores. And so a lot of times we'll have somebody come and say, "Oh my gosh, look at this French bond's paying 14%."
Yeah.
Right? And it's like, well,
There's
you know what
reason.
that means. There's a reason it's paying 14%.
They're not paying that because they just felt really generous. They're paying that because they offered it at lower rates or wanted to, and nobody would take them up on it. And they had to run the interest rate. And we learned that in 2015 with the muni market, right? When a lot of portfolios were getting these great yields, and then you x-ray in and they're holding a bunch of crazy stuff with municipalities that really weren't as stable as a lot of people thought.
Well, and on top of that, some of the municipalities base their bonds off of revenue, right, instead of a government obligation, and so it might be based off of an athletic stadium.
Yep.
Right. And all of a sudden, if that athletic team is horrific, right, unlike the Dallas Cowboys, but if they're a horrific team.
It's not a good, no.
Oh, is this a bad year for that example?
Here's the thing. It's interesting because on the sport, this is why the Dallas Cowboys won't change because they make so much money.
They're really profitable.
They're the number one sports brand, so they're like, I don't know, we break even each year as far as our wins losses. Why should I invest in? Because they make so much money. Unlike other teams like the Browns or someone who they're like, we would do a lot better if we just won a few more games,
Sorry, we digress. The point being that if if that stadium isn't generating revenue, it may not have the money to pay the interest payments. Therefore, it may be a high risk bond.
And that's why you're getting the higher yield.
And so you really need to be careful. Now, that's not saying that the that high yield or high risk bonds don't play a role in a portfolio.
Right.
Most of the time they do play a role in a portfolio, but should it be the anchor of the portfolio? Probably not. Right. Mm-hmm. And you need to be aware of what risks you're taking with that money, because typically you're buying bonds to counterbalance the stock market risk. So if the stock market is down, you still have a place to pull money from when and if you need money, because it should be more stable, providing a little bit more security, providing some additional income into the portfolio, different things like that. And so you want to make sure you understand what role those bonds are playing for you.
Yep. All right, moving on risk factors, concentration risk. Brandon, we have individual stock, too much in one sector and too much in one real estate project.
Yeah, we see this a lot where people, and it's interesting, a lot of times people will come to us and be like, I can't stand the stock market risk. Like I don't want that. But then I look and they've got their entire portfolio or half their portfolio in gold. Right, like one thing, or they'll say, "Hey, I markets." I've had this multiple times. Markets make me really, really nervous, and then they have more than 3/4 of their money in one individual stock, one stock, and the idea behind that, where do they feel comfortable?
That's interesting. It's funny because I don't know. Yeah.
Well, they feel comfortable because they really know that one stock.
Yeah.
And it's a good stock. It's a good company, and all those things can be true, but they don't understand that one stock can fall really fast.
Yeah.
And so you have to be so careful. We as humans, I think we paint narratives in our head, and we get like an idea of what the future is going to look like. And we don't understand that we can't possibly know and predict the future, and that there's actually multiple outcomes. One of those bankruptcy, one of those doing really well, and the more likely somewhere in between. But people get this idea that, man, this is the next big thing. This is going to take off. I just know it's going to happen. Therefore, I feel really comfortable having all my money in this one area. And that is so dangerous. I mean, I've watched huge concentrations in one stock just collapse literally overnight.
So Rex, how much of that's generational? In other words, my grandpa, who died in his 80s 10 years ago, so it kind of gives you where his generation was, would tell me stocks so he owned like 3. You know what I mean? Like it was like, I need this one and this one and maybe this one, and that's all I need.
Yeah.
Are those 3 stocks, because nothing's ever going to happen to those companies.
Yep.
Yeah, it's interesting, right? Because there's times when like Warren Buffett has 50% of his portfolio in one holding.
Yeah.
Right. And so I talk about concentration risk.
Yeah.
Right. That's enormous.
Supposedly he knows what he's doing. So.
Supposedly. The Oracle of Omaha.
Yeah.
Right? So, he's extremely bright, and I would never question his investing prowess ever. But to think that that's a low risk portfolio, you're fooling yourself, right? Just not true. I once heard somebody that was really, really wise make a comment of something to the effect that the concentration is the number one builder of wealth and the number one destroyer of wealth.
Ooh, I think that was you, Rex.
Was that?
That was you listening to your own podcast.
That might have been me listening to an earlier podcast. I don't know. It sounded really smart at the time.
Yeah.
So, concentration risk. I don't think concentration risk is generational. I would disagree with that. And so I think even today, we see a lot of people that may work for a company, whether it's a tech company, for a company, and not only is their income tied up into that company because they work for them, so their wages, but also they're participating in a employee stock ownership plan in the company, or they're participating in a stock purchase plan in the company, or their 401k is all in that company stock. Mm-hmm. And they have this enormous position, concentration risk of that company. And again, they have a false narrative that this is, I know,
and they like the company. They want it to do well.
Absolutely. And they're working hard for it. And there's something to be said for that.
Yeah.
But to think that because you're a manager at a local retail location, that you understand all of the non-public information of that company, and you understand all of the debt that they're taking on, you are understanding their growth methods and how they're acquiring other companies and the risks that they're taking that could have an impact on that company. Very few people understand the companies to that level. Mm-hmm. However, it feels really good because I work here and I know it, and I've worked here for 20 years and my checks have always cashed, right? And my experience is for the most part, the stock has increased. Now, yeah, we had a dip in 2000, but normally they didn't have as much money in the company at that time. So a 50% dip on $10,000 going from $10,000 to $5,000 feels very different than a 50% dip on $1 million portfolio going from $1 million to $500,000. Same percentage, but the psychology of that plays on you very, very differently. And so they don't correlate today's higher exposure that they have dollar-wise to previous volatility in that concentration. And I think people need to run through a lot of examples to understand what kind of concentration risk they have and what stage of your life are you in, right? It's very different to take concentration risk when you're 25 than when you're 55 or 65 right before retirement, if that truly is what's going to fund your retirement. That's a very different scenario between those two.
Okay, moving on to the last risk here associated with your wealth and being able to keep it. Liability risk. Car accidents, Brandon. Injury and property, business liability, premature death or injury, and health-related expenses.
Yeah. And definitely not the last risk. There's always going to be,
Last one we're covering today. Yeah.
There's a lot of different risks.
Yeah.
However, I'd say this one is kind of your insurances, right?
Yep.
And when we're talking about, hey, you've built an incredible amount of wealth, how do we make sure we maintain it? Making sure your insurances are intact, right? We want to make sure we've got a good home and auto policy, maybe even an umbrella policy on top of that to cover any extra that might happen. Business liability that gets into, business planning and how you've set up entities to try and create some firewalls so that, if you own multiple businesses or you own a business, it's not going to, as much as possible, not going to affect your personal life. And then obviously, premature death, like life insurance, disability insurance, health insurance, right? It's a huge shame if someone has huge amounts of wealth built and then just a little gap in insurance planning completely demolishes that because they had some unexpected event.
Yeah. Rex?
Yeah, I agree completely that one of the big killers is unexpected life events on wealth, whether it's death, disability, a car accident, whether it's a business partner that passes away and you didn't do proper planning, so you don't have a buy-sell agreement in there, and so now you've got a partner that you don't want, that wants to get out immediately, and so you've got to go through a liquidating event, a fire sale event at the wrong time. Key man insurance to where you've got a CEO that basically is running and driving and creating the growth of your entire company, and they get wooed away by somebody else. And so now all of a sudden your company may go through a 10-year depression as you try and find a new personality that's going to drive that company. There's a lot of different kinds of risks on the liability side of the equation that can really upset the apple cart. And so you really want to be careful and make sure that you're working with a professional that can discuss those things at length with you and make sure that you're aware of what risks you're retaining, what risks you're transferring, and which risks you're eliminating.
Yeah.
So
I think and just kind of wrapping all of this up, right? I think there comes a day in most investors' lives where they recognize that anywhere they put money, there is risk, right? Every asset class has risk. Cash has risk, inflation risk specifically. Bonds have risk, credit risk, and interest rate risk. The stock market has risk. Concentrated portfolios have risk is everywhere. And so what you have to come to terms with is that there's going to be volatility. There's going to be risk in anything that you do. But if we can diversify that, spread that risk out so that when some are doing really poorly, we have others that are doing well. And then we manage our distribution expectation. And we do this with financial planning and say, all right, when are we going to retire? How much are we going to need to take? We forecast out our distributions over the next 5-10 years and really take a look at that and say, all right, how do we build our portfolio so that independent of what the markets are doing, we're still going to be able to draw money off of this portfolio. That's that diversification combined with proper insurances, that's how we help mitigate the risk. And you're never going to be able to make all risk go away, but you can get to a place where you can get really good rates of return and still sleep very well at night, knowing that you've taken care of those. And that's not an insurance product. That's not like people will try and sell an annuity or something like, hey, this is, and I'm not saying annuities are bad and you can never do them, but people sell annuities like, hey, this is going to take all your risk away. And really all it's doing is it's changing what the risk is, right? You're taking market risk away and giving that to an insurance company, but then we take on all these other risks as well. And it's just important that we take a very holistic approach to your risk management.
Yeah. Love that.
That was really well said.
Yeah.
And so it's everything has risk. Now what?
Yeah.
Right.
What are you going to do?
Yeah.
Yep.
Everything has risk. Make some decisions.
Well, I'm going to go find y'all at planwithbaxter.com so I can figure out what risk is good for me. Right.
Yeah. And what risks you're comfortable with.
Yeah. All right. This podcast was produced by the Brandyn Collective in our camp trailer, of all places, here in the Monarch Building. If you found value in the podcast, you can consider supporting us at buymeacoffee.com/Banyan Media. Watch and subscribe to us on YouTube if you're not already at Through the Pines, and you can like us on our Facebook page at Pines Podcast, as well as Instagram at Pines_podcast. This has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.